Hey, thanks for checking out this video on the all-in-one home loan from CMG Financial. You can call this a masterclass or a webinar, but the bottom line is I'm a mortgage coach and my mission is to help you make the best decisions for you and your family when it comes to financing your current or new home. We all have the same underlying goals. Would you agree? You want to save money. You want to grow and protect your wealth, and you want to eliminate your debt. And when it comes to your mortgage, you probably already know that you can make extra principal payments every month, and that'll save you thousands of dollars and shorten the life of your loan. And if you're on that path already, that's fantastic. But what I'm about to show you will help you do that even faster and easier with the same amount of money. But if you're not on that path, then you're just like most Americans. So let me pause for a moment and give you some fun facts on that. We hear a lot about the student debt crisis. And if you add up all the state and federal student loans out there, totals about $1.7 trillion. And I agree that that is horrendous. However, according to statista.com, if you add up all the mortgages that are outstanding in the US, it totals $19 trillion. That's over 10 times the amount of the student debt crisis, and yet no one is virtually talking about that. 62 million households in America have a mortgage, and over 90% of those are on a 30-year fixed. Now consider this, the average age of a first-time home buyer is currently 36 years old, and the average mortgage applicant age is 47. That means if you take out a mortgage today, and you don't move, and you don't refinance over the life of the loan, best case scenario, you're paying that off in your mid-60s and probably in your 70s or beyond. And you know the reality is you're probably going to move or you're probably going to refinance at some point to take out cash, whether it's putting on an addition or you need money for college, etc. Here's the point that I want to make, and the challenge that I want to help you overcome is that if you're going to be paying off your mortgage well into your retirement years, it's going to make it extremely difficult for you to save and have the lifestyle that you want. So how do we change that? In this video, I'm quickly going to share with you 3 concepts that I believe will help you clearly understand this and be able to move forward with confidence. The first concept that you need to understand is the power of compounding. Albert Einstein is quoted as saying, "Compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't understand it, pays it." Has anybody ever asked you, if you started with 1 penny and doubled it every day for 30 days, how much money would you end up with? I want you to take a guess on that right now, and I'm going to share the screen on my phone to show you the power of compounding. Ready? How much would we have if we doubled a penny for 30 days? Okay, so we start with a penny times 2, times 2, times 2, times 2, times 2, times 2. That's 64 cents at the end of 7 days. Okay, you want to update your guess? What are we going to have after 30 days? Times 2, that's day 8, 9, 10, 11, 12, 13, 14. After 2 weeks, we have just shy of $82. Okay, I'll give you a chance to update your guess again. Ready? Day 15, 16, 17, 18, 19, 20. Day 21, you have $10,485. So one last time, what do you think we're going to end up with at 30 days? That's day 22, 23, 24, 25, 26, 27, 28, 29. Day 30, we would have 5.368 million. And if it was a 31-day month, we'd have $10.7 million. Now, if we drew it on a graph, it would look something like this. Starting out at day 1 and going through day 30, it doesn't look like a whole lot, if you remember, until about day 18 or day 19, and then it really starts to take off. And that's great news if you're investing over the next 30 years. As Albert Einstein said, he who understands it, earns it. But he also said, he who doesn't understand it, pays it. And if we look at this graph as 30 years instead of 30 days, compounding interest on a mortgage looks the exact opposite when we pay it. If you keep your mortgage payment the same over 30 years, you pay mostly interest up front, and you don't start paying the majority of principal back until much later. At today's rates, it takes you over 20 years before more of your monthly payment is finally being applied towards principal. The second concept that you need to understand is simple interest versus compound interest. And if we look at our graph again, simple interest looks like this. To put it in practical terms, let's look at an easy example. Let's say that I lend you $50 for 20 years at 15% simple interest. At the end of 20 years, you're going to pay me back $200. Now, if I lend you the same $50 for 20 years at 15%, but it's compound interest, you're going to pay me back $818. That's over 4 times the amount of money going from simple to compound interest. Now, here's where it gets really crazy. Let's say I drop the rate from 15% all the way down to 8%, but it's still compound interest. At the end of 20 years, you'll still pay me $233. In other words, you're going to pay less money to me at 15% simple interest versus what you're going to pay me at 8% compound interest, even though I just lowered your rate by 7%. So which is more important, rate or structure? Say it with me. Structure is more important than rate. And this is why I call myself a mortgage coach, because for over 20 years, I've been preaching to clients that structure is far more important than rate. If you walk away from this video learning nothing else, promise me that whenever you shop for a mortgage in the future, you'll remember structure is more important than rate. All right, I think I've made that point pretty clear. And now you're ready for the third concept, and that's the offset mortgage feature. We call it the all-in-one loan, and it's available exclusively through CMG Home Loans. It's not a new concept. In fact, it's been around for decades in other countries like Australia, the UK, and even Canada. And in the US, the same concept is used extensively in commercial banking. It's referred to as either an offset loan or a sweep account. Simply put, it's home financing and personal banking combined. Let me ask you another seemingly obvious question. When you get paid, where does it go? Maybe it's a weekly, biweekly, or monthly paycheck. Maybe it's variable commission or bonus checks. Maybe it's rent from other properties that you own, or maybe it's distributions from a business or multiple businesses. For most of us, all that money gets deposited into a checking account. But have you ever asked yourself, why? It's safe and we can access it easily if we need it, right? And most banks will give you free checking, and depending on your balances, will charge you minimal fees or possibly pay you a small amount of interest on it. Why do banks do this? Because they're really nice, benevolent organizations, right? No, of course not. They do it because they make massive revenue off of every dollar that you keep deposited with them. What CMG did for consumers like you with the all-in-one loan is the same thing commercial banks do for their most demanding clients. They created a sweep account that takes every extra dollar in your account every night and applies it toward your outstanding loan balance, while giving you 100% access to those same dollars whenever you need them. Instead of having a higher principal balance on your mortgage and your income sitting separately in your current checking account, every night the extra cash in your account gets swept over to lower your mortgage principal, and that means you pay less interest. In other words, every night your money is working for you instead of working for the bank. Does that sound like a good idea for you? Exactly. So think about it. You don't spend your income all at once. Your pay comes in, and then you're going to buy groceries and go out to eat and put gas in your car. You're going to pay your monthly credit card bills and your cell phones, your car payment. You're going to have quarterly expenses like insurance. You're going to have medical expenses, property taxes. You're going to take a vacation once or twice a year, maybe. And then you're going to have your annual income taxes and other different various things like membership dues. With the all-in-one loan, your interest isn't predetermined like your standard compounding mortgage. Instead, interest is computed nightly on the lower unpaid principal balance. And that nightly interest is then totaled at the end of the month and paid out of your account on the 21st of the following month. In other words, even your mortgage interest keeps working for you for an extra 20 days every month. Because your mortgage and checking are tied together, you're essentially keeping 100% of your money working for you, keeping your principal lower until the moment you actually need the money. When you do need it, you access it just like you currently do. With the all-in-one, you're going to have 24/7 ATM Visa access. You're going to have personal checks, online banking. You can make mobile deposits, and then you're going to have a client service team that's dedicating to serving you. The sweep account or offset feature is the real power behind the all-in-one. So whereas your compound mortgage pays off like this, the simple interest feature pays off like that. And with the all-in-one, your loan starts to pay off like this. First, you're going to deposit the money that normally sits idle in your checking and savings account, waiting for you to use it. Things like your emergency fund, money that you set aside for taxes or insurance or even vacation. Then you're going to have your income come into the account, which is going to lower your balance further, causing you to pay less interest. Then throughout the month, you're going to pay your bills as they come due, and that balance is going to go back up. And then you're going to have a paycheck come in, and then you're going to have your payments go out. And then you're going to have a paycheck come in, and you're going to have balances go out. You're going to have a paycheck come in, and that's going to repeat over and over throughout the life of the loan. But because you're paying more principal every month and less interest every month, you're going to pay off your mortgage like our average clients do in 8 to 12 years. And we've been doing this now at CMG for over 18 years. Now, I want to emphasize, you're not changing your spending habits at all. You're simply allowing your money to come into the account, and your spending will continue the way it always does. You're not trying to make additional monthly payments to your principal that you can't get back. You're able to get back all of your funds. This is simply just about letting your idle cash go to work for you instead of the bank. We have that track record that shows that our average borrower on the all-in-one is going to pay off their mortgage in that 8 to 12 year period. Some are going to pay it off in as little as 3 years. Some will pay it off in 15 to 20 years. But virtually all of them are paying it off significantly faster and saving themselves tens of thousands, and in most cases, saving themselves $100,000 or more in interest expense. And because it's simple versus compound interest, it doesn't matter how low of a rate you can find. If you can qualify for this mortgage, you will save yourself far more money. So let's take a look at how the all-in-one is structured. Similar to a HELOC, your mortgage is now a first lien line of credit. Like a traditional HELOC, you can access 100% of it for the first 10 years. But unlike a traditional HELOC, you can continue to access a portion of it for the next 20 years. After the first 10 years, every month for the next 240 months, which is 20 years, your available cash is reduced by 1/240th. This way, we make sure that you don't have an outstanding balance at the end of the loan. So using our $500,000 loan amount, even if you pay off your mortgage in just 3 years, you still have access to that $500,000 for 10 years. And then the amount that you have access to is slowly reduced over the next 20 years. I've personally had clients now in this loan for over 17 years. And again, as I said, CMG has had clients in this loan for over 18 years. And this is somewhat typical of what we see. People pay off or start to rapidly pay off their mortgage, and then other expenses or opportunities come up. So instead of refinancing, they simply write a check or wire transfer funds as needed to do things like pay for college, cover unforeseen medical expenses, or invest in more real estate to further increase their cash flow. So what are the next steps for you? Well, there's an interactive calculator on my website, but there are a few default settings that may or may not apply to you. So what I recommend is that you send me a text and we'll schedule a 15 to 20-minute call to plug in your numbers together. And after that, you'll be able to log in and play with it to your heart's content. We're going to look at your exact scenario to see if this is the right product for you, because this is not for everyone. If it's not, then I still have virtually every other product on the market available to you. It's just that none of them will save you as much money as this one. Again, I'm a mortgage coach, and my goal is going to be to help you take the necessary steps, if need be, in order to qualify for this loan as soon as you're able. So who is this loan good for? Well, it's good for people just like you that have major financial goals, that want to get rid of their mortgage and pay the lowest interest possible. It's good for people that are disciplined with their spending. It's good for people who are nearing retirement and want to lower their expenses aggressively prior to leaving the workforce. And it's great for investors who want to buy more properties and develop greater positive cash flow on their existing properties. And just to review what makes it so powerful, well, it's using every single dollar in your checking account for your benefit instead of the bank's. It eliminates a significant amount of interest cost regardless of the interest rate environment. It keeps your money liquid for use without refinancing throughout the term of your loan. And maybe most important, it's easy to use. It doesn't require any change in your monthly budget. You don't have to think about making additional principal reduction payments. Again, I want to thank you for taking the time to view this presentation. If you're ready to pay down your mortgage faster, give me a call or shoot me a text right now. Let's set up a time to plug in your numbers. Let's see if this product's going to really work for you. Call or text me now.